Does technical analysis work? For decades, academics and traders have fought over this. One side says charts predict the future, the other says it's no better than astrology. Here is a single reframe that helps you approach this in a systematic way. Technical analysis does not predict the future. It helps you read the present. This single mindset will help you understand what charts actually reveal and what they cannot. We will approach this through behavioral science, academic research, and probability mathematics. My name is Ashim Nandi. I'm a system architect with 10 years of experience between running an IT company and full-time trading. Charts are like system logs. They don't predict what will happen. They reveal what is happening now. Here are the chapters that will help you understand this concept better. First, the behavioral foundation. You will understand why price patterns form in the first place. Second, the academic evidence. You will know what the research actually shows about technical analysis effectiveness. Third, the systematic framework. You will have a method for using charts as decision support tools rather than crystal balls. Once you go through all of these concepts, you will approach technical analysis systematically rather than mystically. And with that understanding, you will also see how charts integrate with everything we have built so far. Risk management, position sizing, expected value, volatility, liquidity, market structures, and market regimes. Think in odds. Act with discipline. Let's begin. Chapter 1. The Behavioral Foundation. Why patterns exist. Price patterns are not mystical formations. They are visual representations of aggregate human psychology. And we humans have decades of behavioral finance research, including 2 Nobel Prizes, that explains exactly why. The first mechanism, anchoring bias. Kahneman and Tversky demonstrated that humans fixate on reference points when making decisions. In trading, these reference points become support and resistance levels. Previous highs, previous lows. Round numbers, purchase prices. Other researchers, Donaldson and Kim, confirmed that multiples of 100 act as psychological barriers in the Dow Jones. Not because of magic, because traders collectively anchor to these prices and act accordingly. When enough traders believe a level matters, it matters. The concentrated buying or selling pressure makes it real. The second mechanism, prospect theory. Kahneman and Tversky proved that losses feel twice as painful compared to gains. This 2-to-1 pain ratio isn't theory. It's a measurable neural response. In practice, this is what happens. After gains, traders become risk averse. They sell too early. They lock in profits. After losses, they become risk seeking. Hoping to break even, they hold too long. This creates predictable selling pressure around break-even points, and it explains why trend persists. Loss aversion prevents timely selling. The third mechanism, the disposition effect. Schefrin and Stateman documented that traders realize gains at a 50% higher rate than losses. This explains why price hesitate at previous resistance, where many bought, and why breakdowns from support accelerates, forced selling when pains from losses exceed tolerance. It is not mysticism. It is measurable human behavior, repeating across millions of trading decisions. The fourth mechanism, herding. Information cascades cause early investor actions to be observed and followed. This generates self-reinforcing momentum. Research shows herding intensifies during market stress. The 2008 crisis, COVID-19, both triggered pronounced herding behavior. This is why trends once established tend to persist beyond what fundamental changes would justify. George Soros calls this reflexivity. Perceptions influence actions. We change reality, which changes perception. A feedback loop. Technical analysis captures these reflexive dynamics. The patterns are not predicting the future. They are revealing the psychology happening now. But understanding why patterns form does not tell you whether they will work in the future. That requires looking at the evidence, which is what Chapter 2 gives us. Chapter 2. What the research shows. The most comprehensive analysis comes from Perk and Irwin's 2007 meta-study. They reviewed 95 modern academic studies on technical trading strategies. The results? 59% showed positive outcomes, 21% negative, 20% mixed. That sounds promising, but there's a critical detail. Profitability declined over time in developed markets. Early research found technical analysis profitable in forex and futures. Modern studies showed strategies working at least until the early 1990s. Markets became more efficient as strategies became known. The edge got arbitraged away. Andrew Lowe at MIT provides the intellectual framework that explains this. His adaptive markets hypothesis connects both sides of the debate. Markets aren't either efficient or inefficient. Efficiency varies over time-based environmental factors, number of competitors, magnitude of profit opportunity, participant adaptability. In Lowe's own words, investment strategies will perform well in certain environments and poorly in others. This explains why technical analysis profitability declined in developed markets while persisting in emerging ones. Lowe's research also validated something important. Using non-parametric statistical methods, his team tested chart patterns rigorously. Head and shoulders, double tops, rectangle bottoms, these patterns showed statistical significance. His key insight, the distinction between technical analysis language, support and resistance levels, and academic language, autocorrelation patterns, is primarily linguistic, not substantive. Both describe identical statistical phenomena. The strongest academic support exists for momentum strategies. Jagdish and Titman's 1993 research established that buying recent winners and selling losers produces approximately 1% monthly excess returns. This effect has persisted across decades, international markets, and in multiple asset classes. Their 2023 follow-up concluded the widespread nature of momentum returns provides perhaps the strongest evidence against the efficient market hypothesis. Momentum is essentially systemized trend following. It is technical analysis validated by academic discipline. Now, the critics deserve acknowledgement. Nassim Taleb called technical analysis no better than astrology. Burton Malkiel argued a blindfolded monkey throwing darts could match expert stock pickers. Eugene's efficient market hypothesis directly attacks the premise. Here's the key. These critics are attacking predictive claims, and on prediction, they have substantial ground. Charts cannot reliably forecast future prices. Data mining creates illusory edges. Transaction costs erode returns. Survivorship bias inflates expectations, but sophisticated practitioners have largely abandoned prediction for something different. Probability assessment, risk calibration, regime identification. Critics attacking fortune telling and practitioners focused on present momentum awareness are often talking past each other. Both can be correct. But knowing the evidence still does not tell you how to use technical analysis systematically. That requires the right framework, and which is what exactly Chapter 3 delivers. Chapter 3, the systematic framework. Reading, not predicting. Senior strategist James Stanley articulates the thesis directly. Technical analysis does not work because it does not have a job. It is simply a form of analysis, a way of looking at something. But the trader has a job, and the job is to manage risk. And for that, technical analysis can be helpful. This is the reframe. Charts do not predict the future. They help you read the present. Application 1. Regime identification. This may be the technical analysis highest value use. Markets spend approximately 70% or more of the time in ranging conditions. Only 15 to 20% of the time do they trend. A trend following strategy in a ranging market loses money. A mean reversion strategy in a trending market gets crushed. Technical tools identify which regime is active now, not which regime will come next. ADX measures current trend strength. Bollinger Band shows current volatility compression. Higher highs and higher lows reveal current bullish structure. The institutional approach uses hidden Markov models and statistical methods, but the underlying principle is the same. Match strategy to current conditions. That is situational awareness, not forecasting. Application 2. Probability calibration. Thomas Bulkowski built a database of over 30,000 chart patterns. His research reveals critical context. A trader expecting to make 40% or more on downward breakouts can expect success only about 26% of the time. Only in 4 trades. Failure rates have increased over decades. Failures in 1991 were a third of what they were in 2007. Long patterns outperform short ones. Heavy breakout with volume improves performance. These aren't predictions. They are base rates. The systematic trader uses pattern statistics to establish prior probabilities. Current price action provides likelihood evidence. Probability is continuously updated. This is Bayesian thinking applied to charts. Not certainty, probability calibration. Application 3. Risk calibration. Technical tools measure current conditions for position sizing. ATR, average true range, measures current volatility, not future volatility, current. In our position sizing video, we used ATR to adjust position size. Higher ATR means smaller position. Lower ATR means larger position. Support and resistance levels define stop losses. Not because price will definitely reverse there, but because these levels represent current psychological concentration points. If support breaks, the thesis changes. Exit makes sense. If support holds, the thesis remains valid. Stay in the trade. Application 4. Integration with expected value. Remember the expectancy formula from our earlier video? Expectancy equals win rate times average win minus loss rate times average loss. Technical analysis provides inputs for this calculation. Pattern statistics inform win rate estimates. Support and resistance distance defines risk-reward ratios. Volatility measures calibrate realistic profit targets. A 40% win rate with 1:3 risk and reward produces $60 profit per trade on an average. A 60% win rate with 1:3 risk and reward produces only $20. Win rate does not equal profitability. Expectancy does. Technical analysis contributes to expectancy calculation, not by preceding outcomes, but by providing the probability context. Let me show you how this integrates. You identify a potential trade. Market structure shows an uptrend. Higher highs, higher lows. That's current regime. Trending. A pullback to previous resistance, now support, presents entry opportunity. ATR is elevated compared to the 20-day average. That's volatility context. Reduce position size. Pattern statistics suggest similar setups work 55% of the time with 2:1 reward and risk. Now calculates expectancy. 55% times 2R minus 45% times 1R. That's 1.10 hour minus 0.5 hour plus 0.65 hour per trade. Positive expectancy. The trade is worth taking. But notice what technical analysis provided: current regime identification, entry context, stop loss placement, probability estimate, risk and reward calculation. Not a prediction, a probability framework. Reading the present, not forecasting the future. This is how quantitative traders use technical analysis as one input among many. Filters, not signals. Regime identification, execution timing. The CFA Institute notes that the technical analysis community split in the last 20 years, with the great big P's cleaving off and calling themselves quants. They took a large body of knowledge from the technical approach, made it disciplined, and backed it with higher math and statistics. That's the systematic path. Technical analysis is neither astrology nor alchemy. It's a toolkit for reading current conditions, establishing probability contexts, and managing risk, not predicting the future. The behavioral science explains why patterns form: anchoring, prospect theory, disposition effect, herding, human psychology made visible on a chart. The academic evidence shows what works and what doesn't. Momentum has the strongest validation. Probability has declined as markets became efficient. Predictive claims deserve skepticism. The systematic framework provides the application: regime identification, probability calibration, risk management, integration with expected value. In our first Principles of Trading series, we are building a complete system: risk management, position sizing, expected value, volatility, liquidity, market structure, market regimes, and now technical analysis. Now that you have this framework, the next question becomes: technical analysis reads price, but what about the value? When price separates from fundamentals, where does the advantage come from? That is what fundamental analysis gives us: the other lens, reading value, not just price. Think in odds. Act with discipline. See you in the next one.